literally with a case of, or three of us, with a case of beer and a box of cigars, and we wrote a business plan. All the great banks, the great community banks in Illinois were bought by the big banks. Illinois was the last state really to change their banking laws. There were unit banks all over the state. They were not allowed to have multi-bank holding companies. You could not have to figure out how you had a branch is like figuring out units on your phone bill. It was very complicated. They changed that law. When that happened, all the great community banks got bought up by the bigger banks, getting out into the suburbs, and there was a real rush to do that. What we saw was the opportunity to go and take the place of those community banks. The market said that, our market research then and now still says that 50% of the people out there want that high service, high touch delivery that you get in a local bank as opposed to a large commoditizing bank. So, we went out and raised some money from friends and neighbors and family and opened up 1,200 square feet in Lake Forest. And there we go. So it was 22 years ago that we did that. We've grown into 15 chartered banks in Illinois and Wisconsin. 9 we started from scratch. 20, we've done 20 acquisitions. Since the fourth quarter of 2003, we've done more than that actually. We now have over 120 banking locations throughout the Chicago and Milwaukee areas. We bought trust companies. We're in Canada now with one of our businesses. A third of our portfolio is our loans come from our niche businesses that come from all over the country. 3 of our businesses are actually national now. In early years by design, you didn't know who Wintrust was, and that was, as I said, by design. We always positioned ourselves as a local alternative to the bigger banks, and we didn't want anybody to know that Wintrust even existed. So, but that's changed recently. Slow on the uptake here. There we go. But here's just a real profile window of community banking with the 15 chartered banks. Milwaukee, Wisconsin, and Chicago area. Our market area is Northwest Indiana, all the way up through north of Milwaukee. Any place we can get to from Rosemont, where our offices are, in 2 hours. It's everything you would expect out of a bank. Same or better products, same or better delivery systems. We kill you with service. That's how we do it. We offer all the products that you would expect out of a bank. We also have Wintrust Mortgage, which is a national mortgage company. We do business in all 50 states, and we're, I think, the 30th biggest mortgage company in the country. We started that from scratch. In commercial banking, we tied it all together with community banking. We brought the Wintrust name into because we've grown to be the 2nd biggest bank headquartered in Chicago, and we had to get the Wintrust name out so people would understand. But we sub-brand the banks, Lake Forest Bank and Trust, the Wintrust Community Bank, or Hinsdale Bank, the Wintrust Community Bank. But then we sell Wintrust Wealth Management, Wintrust Commercial Banking. So we've moved in, we have offices in the city, we've moved into the middle market. In just 2 years, we've got about 10% market share in that, and we continue to grow very nicely there. So we do bigger deals. Our legal lending limit's a couple $100 million. We have an internal hold limit of about $25–30 million, but we're playing with the big boys now and doing very well at it. A third of the portfolio comes from our specialty finance businesses. So a third of our loans come from non-conventional things that you would expect from a bank. Premium finance. You don't know what that is probably, but insurance premium finance. You go get your insurance policy. If you're a business, you get your insurance policy, and you can either pay cash. Sometimes the insurance company will offer terms, or you can finance it with us. We do $6 billion of that paper every year. It's $20,000 average ticket size, so it's a lot of volume we put through. And we do that up in Canada and in the United States. We also lend on life insurance policies also for estate planning, for succession planning for professional firms and the like. And that's a $2 billion portfolio for us. And we have other niches too. We're one of the largest lenders to the McDonald's system nationally. So we put a third of the portfolio there, and then we use 2/3 of the portfolio to handle the day-to-day business that you would expect. And then our wealth management business, which has the Chicago Trust Company, Whemer Investments, which is our broker-dealer, and Great Lakes Asset Management, which is our asset advisor, has grown to $18 billion in assets under administration there. So we started that from scratch, bought some companies in there, and were able to build that. So that's an overview of Wintrust, and that's starting from a card table. You can see our growth charts here from 1991 through current, where we're We're about $18 billion. The shaded area, the yellow area is growth that's organic. Recently, we've been growing mostly through acquisitions. We did more failed bank acquisitions than anybody in the country. And here is our number of branches, so you can kind of see our growth chart there. Again, the growth recently, we've done some organic de novo growth, but most of it has been through acquisition as the market continues to consolidate as bankers. It's very slow getting out of this current recession for banks under $1 billion in metropolitan areas. When they do get their head above water, they want out. It's just, the regulatory burden is way too high. They can't get loans and earning assets, and they're not going to be able to put up the numbers that they used to be able to put up. So you see a lot of this consolidation over the next 4 or 5 years, and we're just the guys to pick up those banks. You can see just quickly how we've grown since 2010 and where we have locations. This chart is actually more interesting by the fact that there's lots of room for us to continue to build and grow. We hit our 20-year anniversary, and we sat back. We had no delusions of grandeur when we started this thing. We were going to be the George Baileys of the world from It's a Wonderful Life. But people liked what we have, and we turned into serial builders. So we said, what do you want to do the next 20 years? You know, we don't spend a lot of time looking backwards. We're always looking forwards. And we said, what do you want to do the next 20 years? And I said, no, Chicago's a great town. It doesn't have its own bank. Northern Trust is located here, but they're not really a bank. They really handle more on the investment side and a lot of custody work and things like that, but they're not really a bank. They're actually selling branches. We bought 3 branches from them as they get out of the banking business. So Chicago's a great town, deserves its own bank. Who says we can't do it? So that's our goal for the next 20 years is we're going to be Chicago's bank, and we're having fun doing it. You can see we've grown to be the 2nd biggest bank headquartered in Chicago. We've got a long way to go to catch up with JP Morgan and Harris and Bank of America, but who knows? You know, we're going to keep at it and see where it goes. Just very quickly in our history, because I think this will fit into what we're going to talk about a little bit later. But you know, we grew from 1991, granted from 0, but we grew at 43.5% on assets, compound growth rate. So we grew, although you know, a lot of small numbers helps there. We were the fastest growing de novo or banking operation really in the country at that point in time. And then in 06, we read the tea leaves, and you could just tell there was a cycle coming. You knew it was coming. And I have lived through them before, as we'll talk about a little bit later, and you kind of know what the end result is going to be. So we pulled back. We stopped. We called it rope-a-dope. Muhammad Ali fought George Foreman, and you guys are too young to remember this, but Foreman was bigger and stronger, was going to beat him, so Ali went in the corner for 4 or 5 rounds and just did this and let Foreman slug away at him, and then came out and won the fight. So he took the slugs, came out, won the fight, and that's what we called our strategy at that point in time. And I used the other analogy that it was like things were going wild in 06, and it was like a high school party that you knew was going to get busted, a really good party. And I made our guys leave. So for 2 years they're looking in the window and the party's still going on. But sure enough, 4th quarter of 08, when Lehman went down, we put pedal to the metal and were able to grow and get back in the growth mode, and been growing in the double digits since then through a number of acquisitions. There were dislocated assets, dislocated people, and dislocated banks. We were positioned well to take care of that. So when everybody else was on their tails, we had record years during that period of time and doubled the size of the organization. So cycles repeat themselves. Remember that as we go through some of the rest of our content today. So let's talk about this great recession. I take umbrage with that because I really don't think it was that great. I think it wasn't great by any means. But if you go back to 1979, 1980, when interest rates were 21, 22%, when 4,000 financial institutions went down, the entire industry went down, where commercial real estate was in the tank. It was a lot worse back then. And we didn't have to go out and triple the national debt and have the Fed quadruple the size of their balance sheet to get through all of that. We got through it, came out. The 80s were a great time. But this was a recession that was spurred on by a lot of things, but it was caused by a lot of decisions that were made early on. And that's what I'd like to talk to you about. You know, there's no shortage of finger pointing is who was responsible for this. In this day and age of 24-hour news on 24,000 channels, Everybody, they're making up news, and everybody's pointing, this guy, oh, they did it, they did it, Democrats did it, Republicans did it, Bush did it, Obama did it, the Chinese did it, who knows who did it, but everybody was pointing at everybody, and we live in these 10 or 15 second sound bites, and I don't know how you all came away with that, or who's responsible for this sort of thing, but I'm going to take you back, but they all pinned the blame on somebody. They implied that there were nefarious acts, that this was bad and that was bad, but I'm telling you, it was a whole conundrum of things that caused this, and I'm going to take you through it. We'll go through what the real cause of this meltdown was. Now, bankers, everybody blamed the bankers, by the way. Barney Frank, he hated us. Barney hated us. The president didn't like us at all. The fat cat bankers, we were all bad guys. And the Secretary of the Treasury, Tim Geithner, we'll prevail over the banks. We were an easy target back then because guys did screw up. We were a very easy target to go over, but we weren't the only guys that screwed up, and actually we're not the cause of this. Banks will follow the herd as the herd moves. Banks have very short memories. Where am I again? No, never mind. But they will follow the herd, and they have very short memories, and they'll do what it takes to take money, whatever is considered mainstream. Okay, so to understand what happened, you have to analyze this. I'm going to take you back to World War II and bring you forward, and then ask some questions of you as we go through it that you can think about. Was the decision or policy moral, ethical that got us to make that next step, So let's go back. To gain perspective, let's go back. And we'll all agree that the housing industry is what started this thing, right? That the bubble in the housing industry is what started this whole debacle. So to gain perspective, let's go back. And I'll tell you, America is the only country that you'll find pretty much in the world where a 30-year mortgage is your birthright. You go to Canada, you go to Europe, you get 5-year balloons, you get 5-year arms. Nobody has a 30-year mortgage but us. And it's your birthright. It's been built in. And from the end of World War II until the 1980s, the savings and loan, or thrift industry as it was called, was the source of pretty much all of the housing finance in the country. Back then, you probably don't know this, but interest rates were regulated. How much you could charge and how much you could pay. The old guys used to call it the 363 days. You take money in at 3, lend it out at 6, be on the golf course by 3. The business was pretty simple. There was no competitive environment for interest rates. This is what you paid, this is what you lent it out at. It was a pretty simple business. And so because of that protection of rate environments, the savings loan industry would borrow short and lend long. Mismatch, right? So what happens? And they were protected. Well, you got to go back. You've read about it, I'm sure, the oil embargo, the inflation that took place in the late 70s, early 80s. We were given raises, people were given raises 2-3 times a year just to keep up with double-digit inflation. Gas lines, you hear about it. I'm sounding like an old man, but 30 cents a gallon, it was when we were kids. But the OPEC took over. That kicked in a lot of inflation. There was a lot of wage inflation. There was a huge inflationary spiral that took interest rates. So the Fed, Paul Volcker, comes in and says, we have to stop inflation, because inflation really is truly one of the great eroders of wealth any place, is inflation. Paul Volcker comes in, Paul Volcker wrote the Volcker Rule that you hear now, same old guy, and says, we're deregulating interest rates, so they can go wherever they want, and took the Fed funds rate up to 21%. 21%. My first mortgage was at 14%. I was happy to have it. Your lives so far, you've all lived in zero interest rate environment. You don't know the difference between that and now, but I'll tell you, we'll talk a little bit later, but get ready. So what happens is, the rates go up. Savings and loan industry, who's got a bunch of mortgages on the books at 5 or 6%, now has to pay 20% for their money, 18, 20%. How long can they last? 3,000 go under, the industry's wiped out. The recession that occurred, millions lost their jobs. You imagine, okay, now you've underwritten your real estate. You own commercial real estate. You've underwritten your real estate, now you're paying 20% on your loan. You can't move fast enough to get the rents up. Or if you're in speculative real estate, the values pummeled, the values went down. It was a miserable, awful time to do that. Millions of people lost their jobs. As I said, an entire financial industry was wiped out. But at the end of the day, inflation was tamed. So that Volcker raising the interest rate, you have to look back and go, look at all the pain and suffering that caused. Isn't that an ethical move on Volcker's part? To do something that drastic, to put an entire industry out of business, put housing in jeopardy. But at the end of the day, it worked. People went back to work. So you got to ask yourself, was that move something that you would have done at that time, or something that people would do now? It certainly wasn't a popular move. The misery factor was quoted back then, and that's why Reagan got in and Carter took the brunt of it. You know, I hate talking about politics, but the way the environment is right now, that the government has so much control, you can't help but bring some of these guys in. So this is not a political speech in any way, shape, or form. I'm right down the middle on the politics side of things anyhow. But you have to ask yourself, that was a huge thing that those guys did to serve the economy. Was that the right thing to do? I mean, you hurt a lot of people. Okay, so now we have a conundrum. Where do Americans go to get their 30-year mortgage? Their birth rate, they gotta be able to get it. So enter the GSEs. We all heard of Fannie, Freddie, everybody heard of the GSEs, right? There's a proposal today to do away with them, which is just mind-boggling to me. But so what they did was they would accumulate the loans. So a bank would make a loan, they would sell it to Freddie or Fannie. Now remember, underwriting parameters, you had to have 20 or 25% down, you had to have 30% debt to income coverage for the loan itself, total debt to income of 35%. That was the mainstream. That was how you got a mortgage loan. Anything outside of that was considered subprime lending, okay? So they packaged these up and they would sell these loans. And this worked really well. We were the envy of the world. The fixed mortgage-backed securities market was very fluid, very, people would invest in them for a long period of time before this changed. And we'll talk about the timing of that. First mortgage loans were the least riskiest of any asset a bank would have on their balance sheet. It was the least riskiest asset that you could possibly have. So, so what happens? The mortgage-backed securities market is doing well. Banks go in and they emulate the GSEs, put their own private label packages together, all prime-rated stuff, all underwritten properly. And that market thrives. I mean, there's a huge mortgage-backed securities market. Mortgage bankers came into the banks, so you didn't have to go to a bank, you could go to a mortgage banker. So the distribution moved away from banks, and storefronts, you'd have mortgage bankers who you could go, mortgage originators, and they'd do it, they'd sell it to a bank, or somebody would package it, and it would move on. It really, really did work well. Underwriting was consistent, conservative, risk-free for first mortgage loans. The mortgage-backed security was efficient, robust, but then our friends at the government get involved. The Clinton administration, and you can look at it, there's articles on this in 1999, the New York Times has an article that what he and Cisneros, what they decided to do was to, they wanted to raise the home ownership rate. Now the home ownership rate came up after World War II and stuck right around 60%, okay? 60, 62%. And that was, and again, that was a risk-free asset that we were holding, so they were underwritten properly. So they decided we need to raise that up, okay? So it stayed there till 1999, and then to increase this number, what they did was they said, okay, we're gonna reinvent the underwriting for first mortgage loans since they're so safe. And they lowered the standards to what are basically subprime standards. Okay, you could put 0 down, put 1% down, you could put 5% down. You didn't have to come in with any documentation. There was no doc loans. So you just say, yeah, I'm worth this much and I make this much. Sure, here's the money. Home ownership went up to 70% when that happened, right? Things were going wild. People were buying everything. The rating agencies would look at these and they would rate them. Here's the article in the New York Times that talks about Fannie Mae and Freddie, Franklin Raines, who you've heard of, I'm sure. It was the chairman, and they met with the Clinton administration, and they changed these laws, and they changed these rules, and they moved subprime lending and made it mainstream. So these are the, you had Alt-A, low doc, no doc, some doc, subprime, anything you wanted. There was no safe and sound underwriting. That was pushed aside. Never came back. Large banks and investment, it became normal. So remember we talked earlier about these big banks that were doing packaging loans. They're not going to stop. They're going to compete. This is mainstream. The government can do it. We can do it. They start putting deals together. So they're putting these deals together. The rating agencies follow through and call them AAA. Because of past history, there weren't any losses. So they're saying, boy, this works. This is fine. And it works as long as the pinwheel keeps, the carousel keeps moving around. And then it stops. It was a big party. That's when we left the big party. So what happened also that poured gas on the fire, believe it or not, was the 9/11 attacks. When the 9/11 hit, remember the government lowered rates to 1%. Now they hadn't been 1% ever. I mean, in my lifetime, it had never been that low. To stimulate the economy, they lowered interest rates to 1%. So people start searching for yield. That gave even a bigger voracious appetite for these securities that were being put together by the banks and the GSEs. So everybody's searching for yield, and the logic, their homes will always go up in value, nothing to worry about. Home ownerships are in the 70s now, and a bubble is created just like tulips in Holland. I mean, it's just supply demand, just like tulips in Holland, and what happens with bubbles? They burst. So you can see, this just tells you, at the peak of the market, this is where home prices have gone, supply and demand. Free money, people are going to buy houses. So you can see the median price of the home, and you can see the average home to median income, okay? For years and years, 3.5 times, went all the way up, 5 times, 6 times. That's unsustainable, it would not work. So, and prices went up because of the supply and demand, the bottom fell out. So, here's your question. Was it more to try to raise the home ownership rate? I mean, were they doing something bad when they said that? I mean, that's a noble cause, I would think. But for the means by which they executed their strategy, lowering the credit standards, bringing it down, was that right? Were the nation's financial institutions drawing and emulating the government's move? They're just, hey, it was normal. Should they have done that? Who's responsible for all of this? Were the actions of the credit agencies who used past history and cash flows before it tanked? Were those agencies flawed? Did they screw up? Was there something bad going on there? The Federal Reserve keep interest rates too low, too long, for political reasons, well, the real question is, because I asked that question now, we're seeing it again. They're keeping rates too low, too long now. You're starting to see it in the banking industry. The credit standards are loosening up again. It's a little bit scary. But did they keep them too long, too low, too long? And is the Fed now become more political than independent as they're supposed to be? So you have to ask, so who's responsible, right? You say, everybody pointing fingers, Republicans, Democrats, this policy, that policy. They made subprime mainstream. Subprime never works. You could look back in history and the subprime market pops up, it does really well, and then the bottom falls out. I can name 12 subprime companies on the mortgage side and on the auto side that have gone out of business. There were flashes in the pan, but it's funny. Investors will buy it, they go up, and then the thing just tanks. It falls over based on its own weight. And it just, you have to have the money. If you're going to borrow money, you have to be able to pay it back. And if you don't, then it falls over. The independent mortgage brokers and bankers who made these loans to consumers doing so under an unethical premise, did they, if somebody's going to buy, you can get a loan with 0 down payment and no documentation, and you can buy a house, and a guy gives you a loan. Was he a bad guy for giving you that loan? Who's responsible? Is the borrower responsible? Is the guy who borrowed the money, is he a victim? Or should he have been smart enough to go, I can't pay this back, and looked at the numbers and said this doesn't make sense? Or was he smart to take the free money and make a run at it? Who's responsible for all of this stuff? The broker-dealers who sold the mortgage backs, were they unethical? I mean, people were buying them, people sell them. Is that wrong? I don't know. So the government's response to all of this. And I remember we talked earlier about the the late 70s, early 80s, and the issues that went on there. But the government's response was to stimulate when this hit. And I'll go back. Well, one of the things that really exacerbated the credit meltdown in the fourth quarter of 2008, two things that have been alleviated by the market. One was the uptick rule. Now, the uptick rule is for short sell. Everybody know what short selling is in the stock market? Sell the stock, you don't own it, you think it's going to go down, so then you can sell it, and you sell it on margin, and you buy it back cheaper, and you make a lot of money. In the old days, you could not short sell a stock if it was not on an uptick. You couldn't pile on when it was going down. So the stock had to be moving up before you could do a short sale on it. They did away with that rule. So when they did away with that rule, short sellers just rode this thing all the way down. There was no time to take a breath anywhere in this. And the other thing was mark-to-market accounting. You keep marking the market, and you got to mark down, down, and there's nobody to buy, down, down, down. It accelerated the fall into the hole here. So it's an interesting story. When the government went to put all of the stimulus in place. So the stimulus being fiscal stimulus through the government spending, monetary through the Federal Reserve, and TARP. I remember TARP. When TARP first came out, it was an initial response, and we all got TARP. We took TARP. We paid it back real fast after they switched it. But if you weren't a good bank, if you weren't a healthy bank, you couldn't get it. So if you didn't take it, the investment community thought something was wrong with you. We didn't need the money. We had plenty of money. We took the TARP, and then we got it, and then it became a scarlet letter to get. But when the TARP was going on and they were voting on it in the House, Mark Kirk, who was our congressman, I always admired him because he was a congressman in the 10th district, and he would call the businessmen every day in the 10th district. He called me, he called a couple other bankers, and we would talk every day for about 40 minutes. What should I do? How's this affecting my area? And I really admired that. I mean, there's certain guys, Dick Durbin, we're the second largest bank in Illinois, and I've never even met the guy, and he won't take my calls. But Mark was very involved. So what happened was, he goes, should I vote on this? He was running the Blue Dogs. He was running that group of Republicans and Democrats that were kind of in the middle on this, and they kind of worked the Blue Dog Democrats and the middle, the road Republicans. And we said, you know what you got to do is you got to reinstitute the uptick rule and suspend mark-to-market accounting. So he goes, will you write that up for me? So myself and one of our other founders, our chief operating officer, we wrote this long paper on what we should do. Next thing you know, I'm worried, it's like 7 o'clock at night and they're debating this thing. And I go, Dave, get in my office. I got the TV on. And it was one of this congresswoman from Ohio holding our letter saying, we need to do this and do that. I go, Dave, look at this. We're at the top of the world, man. Well, they didn't pass TARP and the market went down like $1 trillion the next day. Look what we cost. But they put it in, it did stop it. But the government came through with TARP, with monetary and fiscal stimulus that's never ever been done in a short period of time in the history of the world. And then they came out with mountains and mountains of regulation. Dodd-Frank came out on the banking side. You should know that Dodd-Frank has 268 new rules. They've only written regulations and how to apply them on 55% of them so far. 268 new rules that they haven't even put them in. And I tell guys it's an analogy. It's like, so the house got infested, so they came in with sledgehammers and put holes in all the walls and knocked the house down, but they got rid of the infestation. And they looked around, what happened to the house? So there was the government really did a huge effort to try to turn this around, something that was really never done before. Deficits over the past few years have exceeded the deficits of Washington to Bush. National debt is approaching 100% of GDP right now. Keep that number in mind, 100% of GDP national debt. Federal Reserve has more than tripled the size of its balance sheet. They've gone from $1 trillion balance sheet to over $4 trillion. They currently buy half of the government debt that goes out there. That's how they're keeping the rates as low as they are, by buying all that stuff up. They've stemmed the tide, but only 2.5% growth rate. It's not real big. The government can't afford to raise it. If the government raises interest rate, it raises the deficit. 1% would raise the deficit by 16%. 2%. Now the average Fed funds rate for the last 40 years has been about 4.25. 4.25. We're at a quarter right now. Imagine 400 basis points would do to the deficit. They can't afford to raise it. They're leaving them low real long again. And now you're starting to see some cracks in the system because of that. Now they're starting to taper, the Federal Reserve, we all have to take a stress test now, which is an exercise in futility. It's costing us millions of dollars. We have more applied mathematicians on our staff who are running stress tests for us. The Federal Reserve would not pass their own stress test. They borrow short, they lend long. Remember the S&Ls? They have a $4 trillion balance sheet that's doing that. And they're concentrated. They're concentrated in government debt and mortgage debt. They wouldn't pass their own stress test. I don't know how they're going to get out of all this. The market can't absorb that at any point in time. So it's kind of interesting to the extent that here's just quickly, if you look at the amount of the deficits and where they are, and the amount of public debt coming up to 1 times the GDP. Scary stuff. Scary for you guys. Really scary for you guys. Somebody's got to pay this back. The Federal Reserve, here's the Federal Reserve's balance sheet. It's always been right around there. Look how that's gone. $3.47 trillion, up 290%. How are they going to get out of those securities? Rates move up, they're all going to be underwater. You wonder how they're going to get out of it. But the scariest part of the whole thing, well, I'll tell you, the scariest part of the whole thing is that every time, not just in the United States, but in Europe and any capitalistic, if you can research this if you want, I'm happy to be corrected, but I have researched it, where national debt approaches 100% of GDP, it will be followed by a period of time of double-digit inflation for the same period as the spend. Now you can go back to Vietnam, World War II, World War I, Civil War. You go back to Germany. You can see Germany, the Weimar Republic, before the Nazis took over. They were able to take over because of the economic debacle. They needed a barrel of marks to go down and buy a loaf of bread. It happens every time. And that scares the pants off of me. Because the only way, think about it, the only way the government could pay back that debt is to inflate it, is to make them cheaper dollars. It's the only way it's going to happen. People say, well, the rest of the world, well, it's a different world now, it's a different economy. I don't buy it. I truly believe that the only way out of it is to do that. And they say, well, you have currency fluctuations. You might be able to do it through currency fluctuations because, we'll always have the strongest, even with this, we'll always have the strongest economy, and the rest of the world depends on our economy, so if we go, they go. So in effect, I'll use a politically incorrect term and say we're the tallest midget. I mean, so we can work through this thing because of our strength. But eventually, nobody's going to buy your stuff anymore. They're not going to buy your debt. You're going to have to raise rates to do it, and that's what's going to spark the inflation. That you're starting to see wage inflation take place. Now, that's usually what gets it going is higher interest rates and then wage inflation. What happens when you come out of one of these cycles is that you go into the cycle, people are happy to get a job. They're happy to have a job. They sit there and put their nose down to the grindstone and they work. Meantime, the wealthy guys, you do get wealthier. It does happen. They have the money to ride through. They can take advantage of dislocated assets. They buy them. They all go back up. The wealthy guys get wealthier. The hardworking guys keep their nose down. And then they come up and things start getting better and they want to catch up. So you've seen it, I'm a big proponent of the minimum wage being increased to $10. I mean, it just should be. It should be $12 as far as I'm concerned, or higher. 20,000 hours a year times $12. That's not a lot of money these days to live in this environment. But when that starts occurring, and it will start occurring, you're going to see that inflation will happen. I'm convinced of it. So you have to ask yourself, was providing TARP to the banking, insurance, and auto industry wrong? I'll tell you that on the banking industry, the government walked away with about 18% return on their money. given the defaults, and they made 22% on us in the short period of time we had it out. Where they lost money, where the TARP went bad, yes. GSEs. The GSEs. And we bailed out the banking system. We saved the GSEs and we saved the auto industry. You know, we saved them, but we got bailed out. That's going back to why we were getting, not that I have a complex or anything, but but you know, was TARP wrong? The government actually made money. It did stop. It did provide liquidity to the system. It did stem the tide, but was it wrong? Remember, when banking, insurance, auto, and the GSEs all took TARP. Is the current fiscal policy of running massive deficits, is that wrong? And that's for you guys to answer, because your guys are going to pay the price on this one. The young guys, you hear it all the time in a technique term, you'll hear it, but you are. I mean, either through inflation or somewhere you're going to have to pay this stuff back. How are you going to do it? It's going to be hard on you guys. And is the Federal Reserve's monetary policy right now, is that incorrect? Is it wrong that they are doing what they're doing by more than tripling the size of their balance sheet, by running a balance sheet that would not actually pass their own stress test? How are they going to right size it? I don't know. Just some general comments then on business ethics. And you all take ethics classes. It ain't that hard, guys. It really boils down, and I tell our people this all the time, is a couple of things that'll make you do the right thing. It's the golden rule. Would you want somebody to do, if you do something, you got to always put yourself in the other guy's shoes. You know what was really good at that was Abraham Lincoln. You read about Lincoln and what he does. Lincoln would always put himself in the other guy's shoes, and what does he think about it? Put yourself in the other guy's shoes in any business decision and anything you do, and say, would I want that done to me? Is this my employer? If it's my employer, if it's a customer, it's whatever. Is this the right thing to do? And if you do that, you'll be fine. You'll be absolutely fine. You've got to just remember that your reputation is everything. There'll always be another buck down the road. There'll always be another opportunity. With your reputation, you get one shot at it. And if you blow it, you'll blow it forever. In this day and age, everybody knows everything about you. You'll be Googled up and down. You won't be able to do anything. You need to just remember and keep it very simple and just do the right thing. Ethics is always in the eye of the beholder. We've all read the Greeks, we've gone to the great philosophers, ethos, what is it, what isn't it? It boils down to that right when you get right down to it. So remember, if you think about the motives behind ethical issues in business, money. Money's at the root of all of it. It's all about money. It's usually about money. Money all the time. That's what's going to drive you, and that's what's going to tempt you. That's going to be the apple. Ego. If you think you're the smartest guy in the world, you're not. If you think you're smarter than the system, you're not. Never let your ego get in front of your sensibilities. It's tough to say, and it's tough to do, but big egos always collapse. And you're not this. Just realize, be humble. You're not the smartest guy in the world. We run our business, and everybody's got a say. Everybody all the way up. So all these people have great ideas. If I think I'm the smartest guy in the world, I wouldn't be in banking. I'll tell you that right now. Sex, obviously, gets in the middle of everything. And part of ego, part of my part, but sex is part of the issue. And sustaining the lie. Now you're in it, now you keep going, and it just gets worse and worse. And if you look at the underlying, you end up in a mess. So that's what I'm going to leave you with, is don't end up in a mess. Just do the right thing, and do what you want people to do to you, and how you'd want to be treated. And you know what? It'll all work out for you. So thanks. And anybody got any questions? That was a smart group. Come on. Should have brought a case of beer in here. That would have got you. Yes, sir.
Yeah, I was just curious. You mentioned like in the 2006 area, you were watching through the window as they were going to the party and everything. What were some of those clues that kind of set you off to come out? And what are you looking at now? What are those like significant factors, economic
The question was, in 2006, when Wintrust went into the rope-a-dope, what were the clues that made us do that? And I'll tell you, it wasn't easy. Our stock was trading. We were at one of the highest multiples in the banking industry because of our growth. We were putting up big growth numbers and had it really going. And to call quits on it, I caught a lot of grief. Our stock went from 60 to 45, 46 bucks. And our board, fortunately, stood behind it. They got a little squirrely towards the end, but now they're all patting each other on the back. Great job. But it was a hard thing to do, but we were convinced for a couple reasons. The banking industry has not really changed in terms of risks since the Medicis had the first modern bank in Florence 600 years ago. You got credit risk, you got interest rate risk, you got liquidity risk, you got reputational risk, you got government risk. Regulatory risk or war risk. The War of the Roses, Medicis went down because they picked the wrong side of the War of the Roses. That's how they lost their bank. So you've always had that geopolitical government risk in there also. So when we put our plan together to build this bank, we basically relied on, history repeats itself, and the banking industry and the economy has cycles. And you can't think you're smarter than the market. So we have our circuit breakers, which are like our loan pricing methodology and our loan policy, what we'll lend on, what we'll do, what we won't do. We don't stray from that. We don't chase the market. We don't think we're smarter than the market. We don't chase that. So what was happening was we were seeing deals that fell outside of that middle, right down the middle of the road. And so being an asset-driven company, we always generate more assets than we need, and that allows us to be very aggressive to go out and get more households to come in. If you don't have the assets, you can't do it. So practically speaking, we made a choice to say, we are not going to change our operating standards. This is just the way we're going to run. The second thing was and you could feel it too. You could just kind of feel the enthusiasm, and if you've been through something before, you've seen it happen before, you've seen the movie, you know what the results are going to be. But on the technical side, we had an inverted yield curve. Everybody know what that is? Usually your yield curve is short. The short interest rates are here and the long interest rates are up here. It's the other way around. Short interest rates were higher than long interest rates. When you see that, now pretty much 100% of the time you see an inverted yield curve, it'll be followed by a bad banking cycle or economic cycle based upon the length of the duration of the inverted curve will be the time of the bad cycle, and the depth of the inversion will give you how severe it's going to be. And this was a pretty severe, deep inversion of the yield curve. So technically, we're like, man, every time it happens every time. It's kind of like I'm talking about when you hit 100% of GDP. It's happened every time. What's going to be different this time? So we're like, what's going to be different? So we felt that we kept our powder dry, that when everybody else would be on their backs, we could take dislocated assets, people, and banks. Like I said, we bought more failed banks than anybody else in the country during that period of time. We had dry powder. We had record earnings during that period of time. We doubled in size in that period of time. And every year we raised the book value of our stock. Our tangible book value of our stock went up every year. Our competitors had to go and go out and raise capital because they lost so much money, took their existing shareholders, diluted the heck out of them, took them down maybe 30, 40, 50, 60, sometimes 90% of the value, took it out on the backs of their shareholders when they raised additional capital. We didn't have to do that. We raised every year. So it was technical, gut, and being disciplined that really did that. What we're worried about now, I worry about being prepared for higher interest rates. We are that scares me, but we are well positioned for that. We probably, if you had a parallel shift in the yield curve, but if we went up 400 basis points over a 2-year period, we would double our earnings in that second year. So we're giving up some money now in anticipation of that higher interest rate. But what scares me most is their rates are being left too long, too low again. And in the banking industry, you're getting banks that are now it's taken them a long time to get healthy, and some still aren't healthy, believe it or not, but they are starting to do dumb things again. They're starting to stretch for credit because I take a deposit in at some ripe old rate of 50 basis points. I can put it in overnight funds and lose 25 basis points. I could extend, I guess, and but you can't make any money on your liquidity. So they're stretching and doing dumb things again. Fortunately, there's no shadow banking system out there. We didn't get into the shadow banking system, but there were a lot of conduits and shadow banking. They weren't just mortgages that were put into security form. There were commercial loans that were put in security form, and commercial real estate loans were put in. There was a shadow banking where that the bad underwriting went into that too and made those secure. So it just all kind of tumbled down. That shadow banking industry is not come around yet, but it's scaring me. We're seeing more and more people forgetting the past. Bankers, the amnesiac bankers, are forgetting the past and doing dumb things again. And if that happens, then our circuit breakers, our profitability analysis of each deal, we look at profitability of it, you know, or the terms and conditions move away, we'll hunker down again and wait for it to hit.
I was going to ask too, for these people who will be graduating, and you know the undergrads and graduate students, what might be one of the personal qualities that you look for people coming up into the workforce, especially in the banking industry, finance industry, that you know, tie into some of that questions that you raised?
In general, the qualities you're looking for: hard work. You and I were talking earlier. The crew that came out before, you know, during the go-go days in the 90s, the kids that were graduating from college. I mean, the market was hot, and everybody that came out, it was just a lousy. It was a group of people, of students that were not hungry, that felt they were entitled to a job. They were getting 2 or 3 job offers. They thought, this is great, I'm entitled. They wouldn't work, you know, 5 o'clock, get out of the aisles, they'd run you over. They really had a bad work ethic. And really your first 2 or 3 or 4 or 5 years out of school, if you're not going to graduate school, you go at night, but if you're working, you really got to put your nose to the grindstone. You've got to sit there and not be out at 5. You work as hard as you can, as long as you can. That's the Marines, you know. I mean, it's the. I was a public accounting. I mean, I was a CPA by trade. I spent my first 2 or 3 years. You know, you're working 12, 13 hours a day, 6 days a week, but it was great. As I learned. That's how we learned business. That's how I got it. So you're looking for a really good work ethic. You look at grades, obviously, the qualities, but, you know, I'm a B student. I think B students rule the world, so I had a fight to be a B student. It was hard balancing fun in school and jobs and rugby and all sorts of things. But you look at the grades, but the extracurricular, you can tell a lot about somebody by the extracurriculars they were involved in. You know, I spend a lot of time on that because really the transition you have to make when you get out there. You think, you know, you're going to come out, you're going to graduate, and God bless you, congratulations, you're going to feel great about it, but you're in for a rude awakening. If you haven't been in business or you haven't been lucky enough to intern someplace, the difference between book world and real world is what you got to figure out in those first 2 years. And it's a lot different. You take it from the books to the real world and have to interpret stuff. So you look for the hard work, but you look what people were involved in. I mean, you can be a B or a C student. If you're able to adapt and understand it, you've got great personal skills. And then you can read a lot by, you know, you guys being involved with this organization would mean a lot. Sports means, you know, doing something else and being very well balanced is important. It's hard to judge character, you know, off a resume. And that's going to come, as I tell you, your reputation, you'll start building the day you walk out and the day you get your first job. And your work ethic and your honesty will come across. You know, you see people write loan write-ups. You see, we run 20, 25 credit analysts through our training process every year. And early on, you'll catch somebody and you want to get a deal approved, right? So you write it and you kind of lean towards this way. You want to get it done, and maybe you twist a fact here and there. You're going to get caught doing it, and then your credibility is going to be down. You got to just be straight and honest. Tell them what you think, why you think, back it up. But don't kid kidders, you know. The guys you're going to be working with or working for have been around the block and seen it 100 times. So don't let your ego get in the way and think you're smarter. Just keep your head down and work. Find what you like. Any accounting majors in here? My dad, that was the best advice my dad gave me. He said, I want to be in business. He said, well, what do you want to do? I have no idea. I said, I have no idea. So he goes, go get your CPA. Be an accountant, get your CPA. Because you get to go to clients and you get to ask questions. So you get to go to distributors or manufacturers or financial institutions, and you're a dumb auditor. They don't care if you're stupid. You can ask questions. And that's how you learn the business. And I gravitated to the financial side of things. I have friends who gravitated to the distribution side. They've all done, everybody's done really well. But you have to live and learn and work through it all. So it's going to be fun. You guys are going to have your challenges too if we don't get this squared away. So I hope I don't underwhelm you, and that you learned something here today. And just remember, history repeats itself. It always does, especially in the financial markets. So don't think you're smarter than them. You could be smarter at the beginning and get the wave early, but that wave's going to break. So thanks.
We want to thank Mr. Whemer so much. I don't even know what his time is worth. And he came because he wanted to speak to you. He wanted to speak to the future of people coming up into the business workforce. And so we are so grateful for your time. Thank you very, very much.